Hi everyone, welcome to BISP Solutions. Today under Oracle Tax Reporting Cloud Services, we are going to discuss about equity, permanent and temporary differences accounts. So let's begin. So generally, the permanent and temporary difference accounts are routed through the profit and loss account, or we can say that the tax payable or the current provision which is calculated is generally routed through the income statement, that is the profit and loss account. However, there are a few cases where we have to route the income tax payable through the equity or other comprehensive income accounts as well. The reason being the nature of the expense is equity, or the expense itself are routed through the other comprehensive income accounts. So generally what happens is we pass or an entry is created debiting the income statement, and income tax payable is credited. But there are a few items such as examples. Some of the examples may be stock compensation, or in case of cash flow hedges as well, where the uh, gains or losses are linked to the OCI instead of the profit and loss accounts. So in that case, the income tax payable account will be routed through the equity or the OCI account. So in the TRCS application, there are specific rules for this particular case, whereby we'll have to assign a custom attribute for all the temporary or the permanent difference accounts which are routed through the other comprehensive income. So we'll see a particular case scenario whereby we will route the temporary differences which are created due to the stock compensation reserves, whereby the expense is booked or is adjusted not through the profit and loss account in the financial statements, but through the other comprehensive income accounts. And there is a temporary difference as well, because the taxation laws and the financial books are maintained differently in this particular case scenario, which relates to stock compensation. So the tax adjustment is allowed differently, and adjustment in the financials is done in a different manner, which leads to a creation of a temporary difference or the timing difference. So the case which we are dealing with, we'll just go to the application first, and we'll see how we will have to configure the particular temporary difference for the stock compensation. So I will first go to the configuration. Under applications, I'll go to configuration. And first we'll see the tax automation. So under tax automation, we have for the period 12 of financial year 20, we have certain automation rules. So we have the NIBT, which is getting pulled from profit before tax. Then we have some entertainment expenses, which are permanent difference accounts, which are getting pulled 50% from the entertainment expense accounts. Then we have the some other adjustments as well. We just scroll down and see the one which we are concerned with. So we are concerned with the stock compensation, which is getting pulled 1% from the common stock or the uh, financial account of common stock which we have in our application. So it can be any other account as well. It can be stock compensation reserve account, but since there was no data there, so we have taken 1% of the common stock, which is getting pulled from from the common stock to the stock compensation, which in my case is a temporary difference account. We'll just go to the dimension hierarchy and see the custom attributes which have been assigned. So the source movement for the common stock is the trial balance close, and the target movement will be automated. So now we will see this particular temporary difference account in our dimension hierarchy so that we can see what custom attributes need to be assigned for this particular case. So this is my temporary difference, which is temp stat to tax total. So in this particular account, what we have done is that we have assigned the custom attribute. So the first custom attribute is tax type national and regional. So this particular account will pertain to both national as well as regional tax. Then we have the data type, which is a pre-tax. Since it's a temporary difference, it will be pre-tax. Uh, it's not a tax amount, so it is a before tax amount, so it will be pre-tax. Then the important attribute, which is the new attribute that we have to assign in order for this temporary difference account to be considered as an equity adjustment, is the equity reversal target account. So we'll have to create an equity reversal target account. So there is a particular hierarchy in the account dimension for this particular account as well. So we'll have to create uh, any account under this particular parent, which is equity reversal target account. So I have created one parent, which is equity reversal target account. Under that, there is a child by the name of TRCS, current additional calculation stock compensation RTA. So this is the reversal account in which our data will get reversed from the profit and loss account or the income statement account and will go to the other comprehensive income or the equity account. Another thing to note is that this equity reversal target account is a predefined account in the application. So we can add as many child under this particular parent as we want for as many temporary and permanent difference accounts that we include in our application, which will be requiring an equity adjustment. So for each account, then we will have to assign an equity reversal target account. So in my case, I have also assigned the equity reversal target account to my temporary difference account. We'll be also seeing for a permanent difference account later on. So first we'll assign this and we'll just see the hierarchy for equity reversal. So it's a pre-built hierarchy. We'll just have to add a child to this particular parent. So equity reversal. So this is the TRCS underscore equity reversal total, and we can add as many child as we want under this particular parent, which will then become a custom attribute for our temporary and permanent difference accounts for equity reversal. So we can just see the attributes here. So it's a tax account. So we'll have to assign the tax data type as tax, and tax type can be assigned as national and regional as per the requirement. So once this is done, now we will be moving on to the package to see the results. So this is my FY20 P12 for entity operations USD and jurisdiction is United States. So I have my NIBT and the current provision. So I will go to the temporary difference account where I have created the stock compensation account, which is my temporary difference. So I have a temporary difference of 4,50,000. So this is my temporary difference. So my stock compensation, which is booked, is 4,50,000, and the tax rate is, I guess, 21%. So just calculate the tax first. We'll see what is happening here. So the 4,50,000, since it's a temporary difference, it will get added to the tax in the tax calculation, and the taxable income before loss will have this 4,50,000 included in its calculation, and then the tax will be calculated on this taxable income, which includes the stock compensation temporary difference. So my tax will get calculated, current tax as per return after adjusting the losses. So I have paid the tax on my temporary difference account, and the same has been incorporated in the return as well. So my current tax per return is with including the temporary differences. However, since we have assigned the equity reversal for equity reversal account to this particular temporary difference, what will happen is that below the current tax expense as per return, the current provision which gets rolled forward in the TAR form, which we'll be seeing just in a bit. So the TAR form is the form which roll forward the balances from the tax accounts to the financial data. So the GL accounts, basically. So the current provision here will not include the tax on the temporary differences which were routed through the equity, because this particular GL or this current provision is the amount which gets transferred to the profit and loss or the income statement account and not the OCI. So what happens is here equity reversals takes place, which is equivalent to the tax amount on the stock compensation or the temporary differences which are routed through the OCI. So 94,500 is my calculation, uh, which is my tax rate, tax computation on the temporary differences. So this will get reversed before the amount goes to the income statement. So the net income amount which will go to the income statement would be 5604208. The tax would be paid on the full amount as per the return. However, the amount that will go to the income statement will be after reduction of the equity reversals, and the equity reversals will straight away go to the other comprehensive income in this particular case. So my journal entry for the temporary differences would not be income statement debited to income tax payable, but it will be OCI debited to income tax payable, which in our case is included in the current tax expense as per return. And since these are the temporary differences on which we have paid the tax right now, and we will be uh, paying lesser tax on this in the future date, so we'll have to create a deferred tax asset as well, which will showcase in the both the temporary difference form as well as the deferred tax calculation, which again will credit to the OCI. So we'll just go to the temporary differences to see whether the 4,50,000 is showcasing there or not. So this is my total temporary differences. I'll just so my stock compensation amount of 450 is available in my temporary differences, which got reversed from here from automated. This got reversed. You can see it got to zero, and then another entry got created in another movement, which is equity automated. So this is a bifurcation. It moves to equity automated, and this will again get rolled over to the closing balance of the temporary differences. And then on this particular temporary differences, the 21% deferred tax will get calculated. So you just see the deferred tax as well. So for the stock compensation, the zero is here because it gets adjusted here again. And another entry of 94,500 will get calculated in the equity movement, which will again be shown in the non-current liabilities and the closing balance of the deferred taxation. So in this way, this particular entry gets completed. We have got the deferred taxes as well, and we have got the income tax payable as well. And this gets netted out. Debit equity and credit equity will get net off. As you can see, both are the same account, so this gets net off, and we have a deferred tax and income tax payable. And now we will just go to the TAR ones. So under TAR as well, we will be having the amount 5604209, which I'll just confirm. So we have got the same amount, which we have here in the TAR, which will then get reversed in the equity. So our equity automated will have 94,500, and this will then roll over in the general ledgers. So yeah, this was the temporary difference. Another example can be for the permanent difference account. So I have a permanent difference as well created here. So we can see I have a 450, the similar figure here, and I have created a different account for this particular, a different reversal account for this particular permanent difference. So we have another account in the equity reversal for national by the name of equity perm reversal, but you can see that no figure has been reversed here because I have not assigned the dimension, the attribute to that particular account. So I'll just again go to the application, again go to the dimension and assign the custom attribute to that particular permanent difference account. So we have the equity perm reversal, which we'll be assigning to the permanent 11, which is our permanent difference account. And again, we'll have to just refresh the database once. It's going to take some time, so we'll have to wait for a couple of minutes. So now we'll just check the provision once, whether the reversal is showing or not, it's flowing correctly. For that, we'll just have to run the console again. Okay, so we just recompute the ownership once, then again consolidate. So you can see now that equity permanent reversal also has the same reversal amount as we saw in the temporary differences. So we can assign as many as equity accounts as we want for the reversal for each of the temporary and permanent differences in our case, so that the correct accounting treatment and the correct provisioning is transferred to the or is rolled forwarded to the GL balances. So that's it for today. In case you have any queries, you can connect with us at bispsolutions.com. Thanks and have a great day.